from you. Every session we ask you to give us constructive suggestions, topics you're interested in for next time, and we've put together a potpourri of several that have come up in the last 2 or 3 that we thought might be an interesting combination. So we're going to be talking about charities, and we're honored to have Malcolm Burrows from Scotiabank with us as our guest speaker to talk about the donee side, the charity and complex gifts. What do you do when you get complicated instructions, complicated properties, and so on? And then Pamela Liang, as you know, one of our associates in the Estates and Tax Group, will be talking about one particular area that is cultural property and how it can provide tremendous tax benefits if you fit within the rules, and they are changing, and they tend to win back and forth a bit over the years. And finally, I'll be talking about something that's not focused on charities itself, but again, one of the topics that you've asked us to talk about, and that is Canadians with international assets. I'll be talking about inter vivos and testamentary issues in terms of issues to look at and ways of dealing with them, and red flags to watch out for. So, as always, we have people here. We have the webinar. You have in front of you the booklets with our evaluation sheets, which I'd ask you please to fill out and leave with us at the end. And we can entertain questions during the session, but of course the panel will be here at the end if you want to come up and one-on-one ask a question. We'd be pleased to take it. So let's begin. Malcolm, the floor is yours.
Thank you very much, Lorne. Thank you all for coming out early in the morning. I'm speaking without a PowerPoint this morning, but I hope you'll bear with me, and I welcome questions as I go over the next 20 minutes. I want to focus today on gifts of what I call complex property to registered charities, particularly to public charities. And I've been working in the public charity space, even with my role at Scotia Trust and Scotia Wealth Management for the last 26 years or so. And one of the things that I think has been a bit of a holy grail sort of pursuit within the sector over a number of years has been focused on assets that represent significant stores of wealth, but aren't typically donated to charity. So private company shares, real estate, taxable real estate in particular, as opposed to principal residences, and finally art. And Pamela will pick up on a specific piece of art and or a particular mechanism around cultural property. I want to speak to these donations to public charities and some of the sort of considerations around them. I want to start specifically with 3 sort of top-line issues related to them. As a charity, my general sort of comment is approach these asset classes with caution. It's not something that you enter into lightly, yet they do represent significant wealth, but they're also very complex in terms of how they're treated in the Income Tax Act and management issues. But to start off, if you're looking at it from a perspective of being a director of a registered public charity or advising one, or even as a donor, one of the basic questions becomes, does the charity have the charitable purposes that allow this acceptance? And underneath it, are there policies? So essentially, is the charity legally allowed under its constating documents to accept this property and manage it on an ongoing basis? And the second point is, are there actually any policies? If these gifts just show up, I would suggest you're going to have challenges. The second point that I want to mention, just by way of a general point, is there's a whole realm of income tax gifting issues, essentially, that are specific to these types of property that need to be addressed. I find that in most discussions, the focus is on the tax exception, I've found over the years that there's an enormous amount of effort at the time of the gift and in ensuring fair market value for receipting purposes and addressing the issues. The challenge is the third point, which is any charities that accepted these gifts in the past, they tend to linger. They're on your book. Your auditor will address them. You have to make sure that there's adequate policies and procedures in place to make sure that you can manage them on an ongoing basis. It's not just a matter of accepting them and receiving them. It's a matter of ensuring that you're going to deal with them on an ongoing basis as well. And there's often, frankly, if you look at something like private company shares, it's rare for a charity, and there's legal restrictions in parts of the Act and at times around accepting full charities. Full companies, all the shares of a company. So you're typically dealing with other shareholders as well. So you have to think as a charity in a situation like this as a shareholder or as a property owner. You're dealing with municipalities, taxes, environmental concerns, cleanup, neighbors' complaints, etc. Do you have mechanisms in place as a charity beyond the gifting issues to manage it on an ongoing basis? And that applies to all three categories of complex properties that I'm going to touch on today. I want to start first with gifts of private company shares, which I think in many ways are particularly compelling, and I've found a very significant increase in activity and interest on the part of a lot of donors with private company shares, because their wealth, of course, is locked up in their businesses. What's happened over the last 20 years, particularly since 1997, in the Canadian system through the Income Tax Act, is we've seen a series of provisions that have restricted donations of private company shares. In the 90s, the natural place to donate these shares was to a private company, private owner, private company, both non-arm's length entities, one went to the other. And there's a series starting in 1997 with provisions in the Act in 118, 113 to 119, which introduced a set of rules called the non-qualifying securities rules, which essentially restricted, if there was a relationship between the donor, a non-arm's length relationship between the donor and the charity, it could restrict the receipting there'd be no receipt, in other words. There'd be transfer for fair market value. There would be no receipt. And this would apply to, there's outright restriction on private foundations, which was the traditional beneficiary, and there was a qualified restriction on public charities related to, was there an arm's length relationship. And so if you had a volunteer relationship, if you had a board relationship, that could disqualify a public charity issuing a receipt for the fair market value of the private shares that have been received. So gradually what happened in the system is that as a matter of public policy, the Department of Finance and governments of the day began to restrict the ability to make these donations to charity. And so there's, related to these rules, there's a monetization period. So there's a 60-month or 5-year monetization period. If you can essentially turn the shares into cash, you can get a receipt for it. You can't substitute. There's been a number of subsequent amendments. But what it's trying to do is block what is perceived in Ottawa to be self-dealing, which isn't always the case. They often end up being quite frustrating, and they're not addressing self-dealing at all, but I'll leave that political commentary aside. The second set of, and then there was subsequently a second set of rules that further restricted private foundations from receiving shares and holding on to them, the excess business holding rules. This was 10 years later in 2007. And it restricted, it's a very complex regime that we imported from, for the most part, from the U.S. That capped a private foundation from holding any shares over 2% of a class of shares, any shares, public, private, Again, it was trying to break down self-dealing. I won't go into it at length, but the reason I mention private foundations in this context is that there has been a series of measures in the Income Tax Act that have shut down the natural beneficiaries of these donations, because if you're dealing with private company shares, one of the things that I always tell donors up front is you have a counterparty risk. If you are donating shares in your company, you have a counterparty risk, and that counterparty risk is the receiving charity. You have to have confidence that they're going to be a good shareholder. Even if they're a non-voting shareholder, they need to be a good shareholder. Will they be consistent? Will there be an understanding on the part of the organization in 5 years' time, potentially in 10 years' time? And the government instinctively knew this, I believe. That's why there was very little counterparty risk with the private foundation. There's potentially significant counterparty risk because the larger charities tend to have greater capacity, but they also, by their very nature, tend to be large, complex beasts. I know this. I spent the first half of my career working for large public charities, and they are large, complex beasts that you cannot fetter their future activity based on sort of current policy, and that does represent risk. So there's been a huge move towards a way you have these significant wealth holdings in private companies and the desire to donate to charity. This has created a lot of tension and pressure in the system, frankly. So there is a desire on the part of a number of people to donate, but there's a number of formal rules to restrict it. And as I said, there's issues in terms of just receipt of the funds and receipt of the property and the ongoing management of it. The actual donation is fairly simple. So there's a couple of formal you receive as you do for all donations. Charity needs to do an independent restrictions in terms of common shares. If there is embedded capital gain in those shares, often with preferred shares, when there's questions from a charity perspective, what these shares, as when you accept all, need to spend on charitable $1 million in private company shares. Most charities require as well some sort of have to have extra disbursement for the surplus that you can cover. Often overlooked is laugh out loud and long and partially. Always require that the shares be redeemed. So if that helps in our mind, other factors and involved with, I have frankly learning more and more, but that's a consideration. Just on the final topic, as a charity, an annual audit each year, it's really important to assurances, so that ongoing communication with the company itself. So, very briefly, those also had in and out, where but your point's very, yeah, 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 it's exactly right, exactly right. It's having the mechanism to our analysis is that if you're looking at a long-term hold, without some way for the try to avoid insurance. It's related to real estate to public charities, the public housing, you could be dealing with a religious organization. That's common, although land was associated with the private off because of a corporate restructuring. Get these sorts of issues. In many ways, the receiving and transfer issues I found to be fairly simple. Is a disposition for tax purposes. Relatively easy to accept this land. Without an exit plan or without hearing. Talking parts from our fair law issue is value there, and it's manageable. Quite a classic structure where you created you made a donation up front. Possible. There's okay, good. But I've known each other for a few years. And finally, on art, just as an involved in games, we've seen galleries of one sort or another. Also a possibility of donating. Large donations of collections. Off the proceeds will be used. Other ones where we're essentially Pamela will tell you that because there's board, we did a public gallery, and was, I've spent 40 years building this collection. I don't want to be talking bureaucracy and the tax less to him than what happened. Failure of Canada and its
Malcolm, I have a question. You mentioned control, and the ideal has to be consultation where you have control, yet the donor has to feel that he or she has some control. So how do you find that balance?
No, it's an excellent point. So within the context of a public foundation like Aqueduct that has donor advised funds, they're advised, and the foundation board of directors must always retain in the Canadian system direction and control over its charitable property. Exercises and right to clarify. Having that ongoing advocate and frankly just getting up like to do, and then off the whole time. I've been off the whole time. Isn't that lovely? Thank you. And there's the webinar audience, however, is probably will enjoy me less now. Yes, Jim, thank you for that point. It's actually something that I was very involved with. There is a proposal that was developed sort of from late 2000s, and I was involved with part of it through the C.D. Howe Institute, through papers C.D. Howe Institute, try and figure out how, with taxable real estate and private company shares, we could address the issue of capital gains, because candidly, I view it as an inequity in the tax system where you have, if you're a shareholder of a public company, that you have significant capital gain, you can donate and eliminate that capital gain. Let's say you hold it for a year and you eliminate capital gain. If you're an entrepreneur, a business owner, and built a company over 30 or 35 years, yes, there are mechanisms in the system. However, for the most part, there's a very significant capital gains bill at the end of the day, and if those shares are donated to charity, there's no elimination of capital gain. So this is, in my mind, it's an inequity in the system, and it's a geographic inequity as well, regional inequity. But there's also issues of in the government's mind of valuation, of relationship among the parties, and also dealing with many of these issues that I've addressed, just basic complexity. How does the charity, I mean, you have large complicated charities struggle with these gifts. What about the small ones? 50% of the 87,000 charities in the country have no employees and $100,000 or less in revenue. They're voluntary. So the mechanism and what was proposed, this was in part my idea through the C.D. Howe Institute, was to have a 30-day window. So leave it up to the donor to sell either the taxable real estate or the private company shares, and then give them a 30-day window. This was adapted from a mechanism that exists for employee stock options in 102 of the Act, where there's you don't have to donate in kind. You can donate a portion or all of the cash proceeds, and you attribute, you're exempted from capital gains back to the sales date, so whatever is donated. So this was proposed. By the time the proposals were actually put through, the Ways and Means language, when it came out, was probably the most complex and onerous set of provisions that have related to donations in the Act. There was a moment where I said, well, that's not quite what we intended. So careful of what you ask for. It was scheduled to in the 2015 budget. There was a 2-year phase-in period as the details were sorted out, and there was a change of government. And oddly enough, the Liberal government said this isn't on our agenda, so it was pulled. It was supposed to come in effect on January 1st, 2017. So I think it'll be at least another 10 years before we have a kick at the can. Although my friend Don Johnson, who's been a major advocate, thinks otherwise. Yeah. Yeah. Yeah, no, that's always a possibility. Yes, absolutely. Thank you. I will restate for the remote audience that's just joined us. The question is for hard-to-value art, or this applies to any property. Could there essentially be a check exchange where there's a donation and a purchase of the art? So the donor would donate $1,000, $10,000, and then the charity would take the same money. They'd receipt it, and then they would buy the property. And so this occurs often with around special events and things like that as well, and it's been a mechanism that's allowed, certainly explicitly allowed in CRA administrative policy, which is a separate form of law in Canada. Thank you for the question, though. I have a feeling I should cede the territory for my colleagues. So.
Thank you, Malcolm. Pamela, you're up next. Yeah. The light is green.
I can project a little more. Okay, I think okay, we're live. Okay, great, thanks, Phyllis. So good morning, everyone. So I will be focusing on cultural property, including what it is, how such property becomes certified, and the tax treatment that arises from the disposition of cultural property. So to begin, we'll examine the significance of cultural property. These are objects that preserve and record our cultural heritage, that give us a glimpse of the past and allow us and future generations to understand how civilization has evolved over time. And needless to say, the protection and preservation of such cultural property is of special interest to Canada, as is the need to ensure that such artifacts and other items and other works of art that are intrinsic to Canadian culture and heritage stay in Canada. In 1977, Canada introduced the Cultural Property Export and Import Act, in an effort to legislate the import and export of cultural property. The Income Tax Act provides favorable income tax treatment as a means of encouraging private donations of cultural property to institutions and to public authorities. These institutions and public authorities, such as museums and galleries, can then exhibit their enriched collections to the public for public consumption. Certified cultural property is defined as a property of outstanding significance and national importance to Canada, for which a certificate has been issued by the Canadian Cultural Property Export Review Board. I'm going to be referring to them as Review Board for the rest of the presentation. The property may fall into any one of the following categories, which may include military objects. It could be objects of applied or decorative art. It's usually actually objects of fine art, but they could also be scientific or technological objects and other such things such as textual records, graphic records, even musical instruments. So we will explore the tax treatment for individual and corporate donors in more detail later on. But as an overview, the disposition of certified cultural property to designated institutions can result in favorable tax exemptions for capital gains realized and tax credits or deductions for up to 100% of their net income. To be eligible to have cultural property certified, an institution or a public authority has to first be designated by the Minister of Canadian Heritage under the Cultural Property Export and Import Act, which I will refer to as the CPEIA for the rest of the presentation. A designated organization is an institution that is publicly owned and is operated solely for the benefit of the public, that is established for education or cultural purposes, and that conserves objects and exhibits them or otherwise makes them available to the public. As for the property itself, in order to obtain certification, the property must be first certified under CPEIA. Only a designated organization may apply for a certificate on behalf of donors and vendors, and there must be a disposition agreement between the donor and the designated organization. The application for certification is reviewed by the Review Board, which consists of a chairperson and up to 9 other members appointed by the Governor and Council on the recommendations of the Minister of Canadian Heritage. The board evaluates whether the object or the collection is of outstanding significance because of its close association with Canadian history or national life, its aesthetic qualities, and value in the study of the arts or the sciences. An object or collection may be deemed of national importance if its loss to Canada would significantly diminish the national heritage. Certification by the Review Board is only needed if the donor wants the donation to be treated as a gift of cultural property. If the donation is to be treated as a regular gift to a registered charity or to any other qualified donee, then certification is not needed. Generally, when a taxpayer makes a gift of certified cultural property, they are deemed to have received the fair market value of the gift as proceeds of disposition. The cultural property can be donated or sold to a designated organization, or it can be disposed of through a combination of a donation and a sales agreement. Where an artist donates their own work of art that is included as part of their inventory, the artist will be deemed to have received proceeds equal to the cost amount of the work of art to the artist. The gift of each certified cultural property must be evidenced by the filing of the receipt from the donee as well as the certificate by the Review Board. The gift or sale of the object must also be a disposition of all interests of the object itself. For example, a gift or a sale of a residual interest in the object will not count as a gift of the object. And going back to our example of the artist who makes a gift of their own work, if intellectual property rights do not follow the object, chances are the value of the object could be impacted. So for example, going back to our artist, if an artist donates a painting to a museum, but does not also gift the intellectual property rights to reproduce the painting in postcards or on t-shirts or any other materials, the value of the painting for the purposes of disposition may be diminished. With respect to the determination of fair market value, this value is determined by the Review Board, And while CRA generally defers to the review board for the most part, if they disagree with the review board's determination, they may reserve the right to administer the Income Tax Act to determine the fair market value. For the purposes of determining the eligible amount of the gift, the fair market value of the gift will be reduced by the value of any advantage or benefit which the donor is entitled to receive. All applications to the review board for determination of fair market value of an object must also be accompanied by a substantiated monetary appraisal. If a donor or vendor is not satisfied with the fair market value as determined by the board, they may request the review board to redetermine the fair market value. If the donor and vendor further disagrees with the redetermined fair market value, they may then file an appeal with the Tax Court of Canada for a further determination. When an individual sells or donates cultural property that has been certified to a designated institution or to a public authority, the donor does not realize a capital gain. Likewise, where the disposition occurs as a charitable bequest in the taxpayer's will and the transfer occurs within 36 months of the taxpayer's death, there will also be no capital gain. However, with respect to capital losses, these can only be deducted within the limits of the Act. Losses arising on the disposition of personal use property other than listed personal property are deemed to be nil. Losses on disposition of listed personal property can be offset only against gains on listed personal property other than certified cultural property. The taxpayer can use the eligible amount of the gift to calculate the non-refundable tax credit using a formula in subsection 118.1 subsection 3 of the Income Tax Act. I've included here the definitions of total gifts and total cultural gifts for your references. But generally, the tax credit available for total gifts is limited to 75% of the taxpayer's net income, whereas there is no limit for total cultural gifts. The credit for total cultural gifts can be used to offset 100% of the taxpayer's net income. Here I've included a reference to the formula in subsection 118.1 subsection 3, which I will not be attempting to calculate for you this early in the morning, but please feel free to do so at your leisure. For dispositions of certified cultural property by an estate, the gift is deemed to have been made by the donor's estate at the time the property is actually transferred to the designated institution or public authority. The fair market value of the gifted property the fair market value is the value of the gift at the time it was transferred to the designated institution and is used to determine the eligible amount for the donation tax credit. For the disposition to qualify as a graduated rate estate gift or a GRE gift, the gift must have been made by a GRE within 36 months of the testator's date of death, and it must be a gift of assets that is property or substituted property owned by the testator at his or her date of death. So as a recap, because you may not have heard it enough, a graduated rate estate is an estate that arises on and as a consequence of the death of a taxpayer and exists for no more than 36 months after the individual's death. The estate must be a testamentary trust at that time, and it must designate itself as a GRE on the first year's tax return. If the estate is a GRE at the time that the property is transferred to the designated institution or public authority, the donation tax credit can be claimed by the deceased in the year of death, deceased in the year prior to death, the estate in the taxation year in which the donation is made, the estate in 5 subsequent tax years, or the estate in an earlier tax year. If the estate was not a GRE at the time of the disposition, then the tax credit can be claimed by the estate in the taxation year in which the donation is made, or else 5 subsequent taxation years. So where the donor is an artist or is the creator of the certified cultural property, as mentioned earlier, if the gifted object is included in the artist's inventory, the artist may elect an amount not less than the cost of creating the object, but not greater than the fair market value as determined by the review board, to be both the value of the gift and the value of the proceeds of disposition. The only exception to the favorable tax treatment is where a donation is made by a tax shelter. The Act defines a tax shelter as any property for which a promoter represents that an investment may claim deductions or it may receive benefits that equal or exceed the amount invested within 4 years of the property's purchase. So essentially, promoters of these tax shelter arrangements would promise taxpayers donation tax credits that exceed the amount of the price that was paid to acquire the property. And to curb the potential tax abuse, CRA has deemed the value of property donated through a tax shelter to be no greater than a cost to its donor. So tax shelter gifting arrangements may have some of the following qualities. It may be large collections, often photographic, by non-Canadian creators. The purchase price may be difficult to ascertain, or it may be subject to a later adjustment. There may be uncertainty surrounding the legal title of the actual property, or the property was acquired by the donor shortly before donation to resemble an art flip. Or it may state that a purchase agreement can be undone if a minimum fair market value was not achieved or attained by the review board. Now, with respect to corporations, corporate donors are entitled to a tax deduction rather than a tax credit as received by individual donors. Corporations can obtain a deduction for fair market value of the aggregate of gifts of certified cultural property to a designated institution in the year that the gift is actually made, or in the 5 immediately preceding years, provided that the deduction hasn't already been used for the same amount in a previous taxation year. And similar to gifts made by individual donors, the deduction can be used to reduce the corporation's net income to 0. With respect to gifts by partnerships, the results of the disposition of certified cultural property can be flowed through to its partners. For appraisals, this is just a general note that since all applications for certification to the review board must be accompanied by a substantiated monetary appraisal, the cost of obtaining an appraisal will be borne by the donor, though in some cases, the institution may offer to subsidize some of the costs. But returning to our example of the artist who creates their own work of art and then donates that or sells it, because the property donated is the inventory of the artist, the cost of the appraisal may be deducted by the artist to the extent that it's reasonable in the circumstances. If a designated institution or a public authority receives a gift of certified cultural property and later disposes that same property that they received within 10 years of receiving it, the institution must pay a special tax of up to 30% of the fair market value of the property at the time of disposition, unless the cultural property was disposed and given to another designated institution. And on a final note, though the gifting and the sale of certified cultural property is highly encouraged, the process of disposition is not without its challenges. We've already discussed the challenges in determining fair market value, where a donor may disagree with a review board, or even CRA may disagree with the review board. It can also be difficult to find a qualified appraiser who's willing to undertake the risk of performing the appraisal and who understands the intrinsic value of the object and they understand which factors to consider. This becomes even more difficult when the object is not fine art. The application for certification includes questions that are not directly relevant to objects that are not fine art, which makes it difficult for donors and for vendors to sometimes provide the necessary information to the review board, which in turn leads to uncertainty for the review board in determining what the actual fair market value of the object is. With respect to intellectual property, CRA's position is that a gift must be a disposition of the object, and as mentioned earlier, it can't be a disposition of an interest in the object, which may be interpreted as intellectual property rights related to an object cannot be certified cultural property. However, for some cultural objects, the value of the object is linked to the intellectual property rights inherent in them, particularly in the cases of museums and public galleries. As we mentioned before, these are the institutions that are receiving these public arts for the purpose of exhibiting them and may be wanting to reproduce the works of art in merchandise. Therefore, in situations where intellectual property rights of an object do not follow the disposition of the actual object to the designated institution, this can create valuation issues for the review board.
I have a question. If I took a young 35-year-old person, inherited $1 billion income, I want to have
Right. I think I'm going to defer to Lorne.
I'm going to get into how to analyze a client situation when I start talking, John, about the international assets. But what I would try to do is understand what this particular person is intending to do with the wealth. Many young donors today want to be socially involved. So it might be appropriate to set up, for example, with Aqueduct, a donor-advised fund where there is a policy agreed to with this public charity as to what happens when the significant gift goes in. Maybe there's a committee that's created that meets the goals of this particular individual. The individual advises on that committee, and Aqueduct carries it out. And it would be for as many years as the parties desire. That would be one mechanism to do.
Thank you.
Thanks, Pamela. You want to come up and help me get into the next slide presentation, please? Thank you. We've talked about hurdles that the recipient charity may face when getting complex gifts. We've talked about hurdles when we want to get certification before the Cultural Review Property Board. Those are the connections, loose as they may be, with what I'm going to talk about, and that is Canadians having international assets. Over our many Toolbox seminars, from time to time we've talked about vacation properties in Florida. We've talked about having businesses brought to Canada by new immigrants. I'm going to try to tie some of these things together to identify and help us with red flags, what to look for, and some possible solutions. I guess right here I'm going to list the 8 areas that I'd like to talk about. One of the most important is knowing who the client is and what are the facts that are going to be relevant in terms of analyzing where there are problems and how best to solve those problems. And then very often we're looking at clients who may come from civil law jurisdictions, Latin America, Europe, coming to Canada with our common law and the understanding as to how to deal with assets during one's lifetime in a matrimonial regime or on death, with certain forced heirship rules may be very different than what we're used to. Trusts, we're all used to this in common law, but in the civil law system, there is no separation between legal and beneficial ownership. How does that work then in our planning? While we're living, we could be involved in a structure that, for example, we'll get into some of the U.S. entities that are not exactly the same in Canada, and the recognition is different, and there may be double taxation issues, lifetime or on death. When we have a deemed disposition that gives rise to capital gains, a country like the United States doesn't have that, but they have an estate tax applicable to the gross value of the estate. So how do we mesh those things and avoid multiple taxation? Then I'm going to talk about some of the basic rules on Canadian outbound taxation, where Canadians have interests in foreign affiliates that could be controlled or not controlled, carrying on businesses or being involved in passive investment activities. Very different consequences from a Canadian tax point of view. Foreign property reporting. It's a bit of an annoyance, that 1135 form that should be included in people's tax returns, but the CRA will impose penalties if property is not properly reported. So it's an important marker to look for. And then this funny thing called the offshore investment fund property rules. Very complex area intended to block people from putting amounts into, let's say, offshore hedge funds for tax purposes. And then finally, foreign trusts. Those rules have undergone many changes over the years, but there are still opportunities, and we'll talk a little bit about them. The first most important thing is to know the client. I always start out with a questionnaire, and I ask the client to tell me about all the assets, who owns what was it worth, what was the cost, what are you doing with it. It's really important to understand if there are liabilities, mortgage on property, debts owing between family members, and so on. And then it's important to know where and what the property is. Very often clients have a loose idea about what they own. Sometimes it's within a company and they think of it as personally owned. But it's really important to understand the legal ownership. And then when you may have a client, let's say, who has come from the United States, where there is an estate plan involving perhaps a grantor trust arrangement that works to minimize U.S. estate tax, but could give rise to an attribution problem here under subsection 75(2). So you must understand what they're coming with and how what's the impact in Canada and what, if anything, needs to be modified. So those are sort of the technical things, but it's also important to understand the personal elements, the family tree, particularly if you're doing an estate plan with senior parents and then siblings who have problems, perhaps, from youth, and they are carrying these problems through. Currently, it's something that you want to try to draw out from the series of interviews and so on, because if you put the siblings in positions of power where they are just going to be at loggerheads, that's not going to accomplish the goal of the parents. Where are these people from? Do they have citizenship that's going to be carried over into Canada when they have obligations, for example, back in the United States, and so on? So just at a very high level, some of the things to keep in mind, the differences between common law and civil law in this context. In a matrimonial regime, typically in Canada and Ontario, people can have separate ownership of property during the marriage, particularly if there's a matrimonial contract. On death or divorce, we have the notion of net family property and an equalization arrangement. In the civil law jurisdiction, you come in with a presumption of community of property. Everything is shared. Then we look at what happens on death as between these two regimes. Generally, in the common law, we have freedom to bequeath property to whomever we want, but it's not unlimited. Spouses and dependents have claims against the estate, and so that we have to be mindful of those limitations. But in the civil law, there are forced heirship rules that prohibit members of a civil law community from cutting out spouses and children. And there are bona fide ways of planning to accomplish goals that will not be part of forced heirship, but it's generally outside of the jurisdiction, either of France or in Italy. You would look at an international arrangement, such as an offshore trust, that might work to do that. Trusts. We're used to the concept of the separation between legal and beneficial in common law jurisdictions. Civil law does not recognize that, even though there is a convention that was probably 25 years ago entered into, and there are many countries around the world, 82 members, including the European Union, that would include France and Italy within it, to recognize trusts, but that doesn't mean that you can set up a trust in France or Italy. What it means is, for example, in France, just a couple of years ago, they brought in very complex rules to tax trusts because French women were setting up a lot of trusts to minimize their wealth tax and their income tax. But what is a trust? Even though it may be recognized, the civil law countries aren't consistent in determining what are the consequences. It may be viewed as a separate entity. It may be viewed as simply a contract or an agency arrangement. So it's very important when looking at a client with assets in a civil law jurisdiction and a trust to get local advice as to what are the implications. Multiple taxation in life or death. So if we're looking as the client who is a Canadian living, owning assets or on death, as I mentioned before, we know there's going to be a deemed disposition on death for Canadian tax purposes resulting in capital gains. What happens with the foreign jurisdiction? And the foreign jurisdiction, again, could be the United States, which imposes tax on citizenship. Even if the person is living here and has been a resident of Canada for 25 years, they still may be faced with the estate tax that applies to citizens of the United States all over the world. We do have a few treaties that will minimize tax on death, the Canada-U.S. tax treaty being one. It isn't a perfect meshing because of the difference between a tax on the gross value and a tax on the capital gain, but it's intended to provide very significant relief. But there should always be advanced planning ahead of time to try to minimize that potential for double taxation. So let's look at a typical example where I see this all the time, Canadians wanting to invest in the U.S. Detroit came to my attention recently because there were some young entrepreneurs that saw very low values in real estate. They could buy it up and look at significant growth and profits as Detroit rebuilds itself. And when they talk to U.S. practitioners, of course, the first thing that comes to mind is set up a limited liability company, LLC, because it's a flow-through for U.S. tax purposes, but it provides limited liability as if it's a regular corporation. But the Canada Revenue Agency doesn't quite look at it that way. They don't accept that it's a flow-through for our purposes. They say it's a company. So if an LLC is used, you have the potential for U.S. taxation on the flow-through to the member, but from a Canadian point of view, you have corporate taxation that hasn't flowed through. So you have a mismatch. Not a wise choice to use an LLC. Instead, perhaps a limited partnership, or in other circumstances, a regular so-called C corporation in the United States. But that's a marker right away. Canadians have to be wary of using LLCs. And similarly, there are animals in the U.S. pantheon called limited liability partnerships and limited liability limited partnerships. Those are entities that the CRA has recently had occasion to look at in Florida and Delaware, and they've said they've got the characteristics more of corporations and partnerships, so we're going to treat them like LLCs. And again, you've got the possible mismatch, so you have to be very careful with those. Let's say that a Canadian holds U.S. real estate. So we've got a cross-border issue. What do we have to think about in terms of the implications? Well, there's this U.S. estate tax. And at a 40% rate on value of $2 million, when somebody is buying even a condominium in Florida these days, it kicks in very quickly. That's a state tax on death, but there's also gift tax. So if a Canadian owns U.S. real estate and wants to make a gift of it, we in Canada would understand that that could trigger a capital gain. There's a deemed disposition. But in the U.S., there's the gross value of the gift is subject to tax, and it's on the same basis as the estate tax. And if a property is held, but then sold personally, what are the implications? Who is the vendor? A typical structure had been, for years, a Canadian sole-purpose corporation would hold the property to minimize exposure to U.S. estate tax, but on sale, it's an ordinary income to a U.S. corporation, taxed at the federal rate of 35%, and if it's in a state like New York, add another 6%, you're close to 40%. And that's a very expensive tax, keeping in mind that that's within a corporation. So the individual shareholder hasn't gotten any benefit of being able to claim a tax credit against that corporate tax. If there is an individual who owns it, then we can have a low tax rate in the U.S. and a possible tax credit in Canada, offsetting one against the other to avoid double taxation. So here I've just listed some of the ways in which U.S. property can be held individually through companies. Holding it through a U.S. company provides absolutely no tax benefit because what would happen is the IRS would look at that U.S. company as a real property holding company. It would have a situs in the U.S., and therefore the ownership of the shares would give rise to the same U.S. estate tax. Life insurance is a good method for providing liquidity in the event of death to be able to pay that tax on death. But the Canadian Family Trust is the one that we most often are recommending these days. And just briefly to go through the structure, let's say one spouse with resources would contribute the purchase price to an Ontario Family Trust, and the other spouse would be the trustee. The beneficiaries of typical family trust could be the children, further descendants, as well as the spouse who is the trustee. There's a little bit of a twist that we'll come to, but that could be the class of beneficiaries, not the spouse who is contributing. That person can't be a beneficiary, or their estate would be deemed to include the assets going into the trust. If we set it up properly, here are the implications. Insulation from U.S. estate tax and gift tax. And because the property is within a trust, on death there's no will that has to get probated to transfer title. We've avoided probate problems, which can be horrendous in some of the states. We've had difficulties in places like Florida where one client wanted to leave not a particularly expensive condominium to grandchildren. There were 10 of them, and 2 of them were minors. The local court said guardians had to be set up for the 2 minors. And so the cost of doing all this would have far exceeded the value. So I had to go to court in Florida. We engaged local Florida lawyers to get the court to give relief from that unnecessary burden. So avoiding probate is really important. The sale, when you've got a trust, is very favorable because the U.S. will look through the trust as fiscally transparent and allow for individual tax. And when an individual has a capital gain in the U.S., the low tax rate, if it's a long-term capital gain, is only 20%. And in Canada, when we have, let's say in Ontario, a 53.53% top tax rate, capital gains are half included, so 26% is the effective tax rate, 20% paid in the U.S. We just have a differential of 6% paid to Canada. We don't have double taxation. Now let's turn to some of the ways in which Canadians are expanding abroad more and more through businesses, active businesses being created in particular jurisdictions with which we have relationships that I'll get into, or not, and how Canadians are putting money offshore, sometimes with very good non-tax purposes, but being caught up in a web of unintended negative consequences. So our system is based on residency, as are most systems around the world, unlike the U.S., based on citizenship. So we have to declare worldwide income as a resident on what we own directly, but there are also reporting requirements on what we have indirect ownership over, which isn't as well known as it should be. So we've got a foreign property reporting requirement. If a Canadian resident has income-producing property with a cost in aggregate of $100,000 or more, it has to be reported on a T1135 form. If you have a vacation home in California that is not income-producing, that doesn't have to be reported on that form. It's the income-producing properties that are important. And if a Canadian contributes property in the form of cash or in kind to a foreign trust, then that has to be reported, and the opposite, if Canadian receives something from a foreign trust, that has to be reported. And if a Canadian entrepreneur is expanding abroad and creating a subsidiary, that has to be reported, whether it's a controlled one or whether there is a lesser ownership amount, which we'll get into in a moment. And there has been much talk in the newspapers and development within the Organization for Economic Cooperation and Development, the European Union, and the United States to combat what's viewed as tax evasion or aggressive tax planning. It starts with the Apples and Googles of this world being viewed as not paying their fair share of tax, but it's now being expanded to high net worth individuals in various countries. So Canada now has implemented the country-by-country reporting for multinationals. So if a Canadian-based multinational has 6 subsidiaries in 6 different jurisdictions, then there is a master file that is compiled as to the income and tax that's being earned by each of these companies, and that is going to be available to the tax authorities of each of the 6 subsidiary jurisdictions, and vice versa. The next phase of a series of action plans that the OECD has implemented will focus on the individuals, and will say that if there is significant wealth, generally the CRA will say somebody with $50 million of net worth. It used to be 50 million or 30 companies, but that has been dropped. 50 million. They will focus on doing audits, and there'll be an exchange of information about such people between jurisdictions. So for many years, Canada and the U.S., through our Canada-U.S. Tax Convention, have had automatic exchanges of information. Now that's going to be implemented worldwide, not only for companies, but for individuals as well. So a major concern of clients these days is privacy, confidentiality. If you're from China and you know that Canada has a tax treaty with China, it's a concern that the information may be transmitted to a potentially corrupt regime. What happens to you and your family back in China? So those are volatile issues that we grapple with all the time. Here's a typical structure where you're now wanting to commence business beyond just the Canadian borders, selling a product directly into the U.S. The Canadian company has to declare its worldwide income. If there is U.S. tax, because under the Canada-U.S. Tax Treaty there may be a permanent establishment to which profits are attributable, there'll be U.S. tax paid that can be credited against the Canadian corporate tax that's paid. Now, in an indirect way, let's say that rates, in fact, do change, and the corporate tax rate is only 15% federally in the U.S. And in certain states like Florida, there is no state tax. So it might be advantageous, instead of selling directly and having the tax imposed back in Canada, we'll just have the foreign tax, in this case the U.S. federal tax, apply on the sale of the paper. And we build up the balance sheet by reinvesting in the U.S. to take advantage of the lower tax rates. And every few years we see the paradigm change. For many years, our tax rate in Ontario at 26.5% was much lower than, let's say, our neighboring states, Michigan and New York. So when we had tax planning, we would encourage Americans to leave the money accumulated in Canada at the lower rate and not repatriate it back as it was done, let's say, 20 years ago. Now, looks like it's going to go back to where it was. And the focus there is active business income. We also have to be concerned about what happens if there's investment or passive income. So there are various ways in which foreign income can be earned indirectly. A foreign affiliate, we'll talk about the definitions, controlled foreign affiliate, and this funny beast, the offshore investment fund property, and finally a non-resident trust. A foreign affiliate, typically it's one in which the Canadian has a 10% interest, but one looks at the whole Canadian group, and it may be that there is a fracturing of the ownership. But so long as a Canadian resident has at least a 1% ownership of the shares, then the associates within Canada can aggregate and come up with 10%. And that is the base level in order to have a foreign affiliate. And why that's important is because when we look at tracking of the income in the surplus accounts, it's foreign affiliates that give benefits to Canadian corporate shareholders. They have to track their earnings, and the acme of surplus accounts we call the exempt surplus account. This is active business income earned in a so-called treaty country, and that includes some 94 double taxation treaties which Canada has around the world, ranging from high tax jurisdictions like the United States and the United Kingdom to low tax jurisdictions like Barbados or even the United Arab Emirates. And so there are significant planning opportunities that come from understanding who the other side of the treaty is and what opportunities can come up. Plus, in the last few years, Canada has entered into what are called tax information exchange agreements, TIAs, with tax havens to encourage the disclosure of information and support the OECD's desire for transparency. So we have, let's say, about 17 or 18 different TIAs with the Bahamas, Cayman Islands, BVI, and so on. And if a Canadian entrepreneur were to build a hotel in the Bahamas, and it was providing full service just like every hotel does, that's a business. And because there is a TIA in place, the income, even though there's no tax that the Bahamas imposes, that will be considered exempt surplus. And the dividend can be repatriated to a Canadian corporate shareholder tax-free, just the same way as a dividend from a high tax jurisdiction like the U.S. as an exempt surplus dividend can be repatriated tax-free. Then there are other accounts that have to be taken account of. Taxable surplus, that would be income earned in a country that doesn't have a tax treaty or a TIA with us, and that even if it does, it's not active business income. It goes into this account that may not give rise to current tax if we only have a 10% ownership interest, but if there is a dividend that comes back to Canada out of taxable surplus, that will be subject to ordinary income treatment, but there is a foreign tax credit mechanism if there had been tax paid in the foreign jurisdiction to minimize to avoid double taxation. But the important thing here is that this account also has within it this notion of foreign accrual property income, which is the opposite. We talked about how exempt surplus is the acme of what we're trying to plan internationally. FAPI is the nadir. You want to avoid FAPI because it gives rise to current income, even if it's not paid back to Canada. And there's a new account, a new surplus account that was just added a couple of years ago, hybrid surplus. And how this arises is, let's say we have a client that is expanding internationally with a financial services business. And starting in United Arab Emirates, just gotten a license there, but they're hoping to expand into India and other countries. And what I've recommended is setting up a Barbados holding company for the various subsidiaries that are going to be set up as the business succeeds. So Canadian company, Barbados holding, international holding company, and active subsidiaries providing financial services. And the benefit of that is we've got treaties all the way down, so we can get exempt surplus dividends if we want to bring the money back to Canada. But we don't have to. We can take the money out of a jurisdiction where we might be a little bit nervous about leaving it there, but we can take it into a Barbados holding company and use it to capitalize a new Indian subsidiary. And then we want to sell down the road. What are the consequences? The Barbados company, as the vendor, is offshore, and so when it sells shares of a company carrying on an active business, there isn't going to be FAPI, but the capital gain goes into a hybrid surplus account of the Barbados company. And when there's a dividend that comes out of that hybrid surplus, just like any capital gain, in a sense, in Canada, half is taxed in Canada and half is tax-free. But now we have to track that as well. So in summary, we've got foreign income that has to be kept track of in foreign affiliates. We want exempt surplus if we can possibly create it, because that will come back tax-free. Taxable surplus we don't want, but we have to keep track of it because it could give rise to FAPI. Hybrid surplus gives us some deferral until we actually bring it back to Canada, then half taxed. And in the order, first dividends are deemed to come out of exempt surplus, then taxable surplus, and finally hybrid surplus. And once all the surplus is gone, our cost base of the shares of the foreign affiliate are reduced, and if you go below zero, you create a capital gain. Now, when we've got a controlled foreign affiliate, that means that could be a group of less than 5 Canadians. So it's not just one, it could be a group, and they could be unrelated, have more than 50% of the ownership and control of a foreign affiliate. That's a controlled foreign affiliate. And then FAPI gives a real problem for the Canadian shareholders, because as the passive income accrues in the foreign affiliate, it will be attributed ratably to the Canadian shareholders. And current tax is payable, even though the cash hasn't been remitted to pay the tax. If there has been a dividend paid out of it, then we can avoid double taxation. And this is sort of at a high level, passive income. But these two definitions are quite unusual. When you think of passive income, you don't think of, and particularly the investment business, it is a business carried on principally to earn income from property, insuring or reinsuring risks, factoring trade accounts receivable and profits from the disposition of an investment property. So the government has found it appropriate to say to Canadians who are setting up bona fide insurance companies offshore, that's going to be FAPI, unless you take it out of the category of investment business, which would be another lecture. But there are ways of minimizing the exposure to FAPI with a real business. Now, briefly, the offshore investment fund property rules. When the Canadian capital gains tax was brought in 1972, there was a concern about people putting their money into offshore funds, and there were various funds through the 70s and 80s that were created. And so there was an anti-avoidance rule that basically said if your purpose is to put money into a portfolio offshore, we're going to hit you with deemed income. And then that was found not to be an adequate set of rules. And when the Canadian government was updating its trust rules starting in 1999, they were going to impose very draconian rules for Canadians putting any money offshore into any kind of mutual fund or company that had passive investments, to the consternation of the investment community for sure. And so they modified the rules, and we're almost back to where we were in 1975 with the offshore investment fund property rules. They're intended to penalize in the particular circumstances if the purpose is to shift income-producing assets to a different jurisdiction where you're paying less tax than you would have had the assets remained in Canada. And you have to, as a Canadian, have shares of a company or units in a mutual fund to have an interest in that kind of property. And if you have that kind of interest, then what are the implications? If you put $100,000 into buying the shares, you would have deemed income based on the prescribed rate, and you'd have to pay tax even though there's been no dividend, let's say, on the shares necessarily paid with which to pay that tax. And I'll just mention briefly, there have been a couple of cases recently where the CRA has gone after taxpayers who put their money into what they consider to be an offshore investment fund property. And one of them recently, the Burrows case, was held in favor of the taxpayer because the taxpayer was able to convince the court that what they wanted was an investment manager that wasn't available in Canada, that had an excellent record, particularly with hedge funds, and that it was primarily motivated by investment objectives. If there were also going to be tax benefits, the court said that wasn't one of the main reasons. So it's being appealed. And we'll see at the Federal Court of Appeal what happens. But the point being that these are pretty draconian rules, but if there is a bona fide reason, we may be able to avoid them. The non-resident trust rules could be a whole discussion for a day on its own. Just very briefly, Canada has become concerned over the years where Canadians have contributed to an offshore trust, and the beneficiaries may not be disclosed in the trust document. There were often situations where the Red Cross was indicated as the real beneficiary, but the lawyer in the BVI would have in his drawer the list of the family members. So the government said, we can't allow this. So we're going to presume that any Canadian resident who puts money into an offshore trust is contributing, settling an offshore trust, and tainting it, and that trust is going to be deemed to be resident in Canada, a so-called non-resident trust, or NERT for short. And so the individual who contributes is liable for the income, and the trustee of the trust also is liable. And if any beneficiary receives anything, there is liability. A slight benefit comes from a split. If you may have multiple contributors to a trust. So if a Canadian resident puts property in, the property is called the resident portion, and you may have wealthy relatives from outside Canada who contribute to the same trust. That's a non-resident portion. That is not going to be subject to tax at the time of the transfer or income earned on it because it's all non-resident. But the part that is resident will be subject to these NERT rules. Let's look at a typical situation where a settler is a Canadian resident putting $1 million into a Cayman trust, and typically there's a specific corporation set up to hold the investment assets. So if the beneficiaries are Canadian residents and also non-residents, really doesn't matter. The Canadian contributed to it, so it's a NERT. This trust is going to be deemed to be resident in Canada and subject to tax here. And if there are distributions from Canada, there'll be withholding taxes. So let's say that we've not made the transfer to the offshore trust while we're alive, but we're now going to leave Canada and depart. We have a departure tax issue, but we're out now. And the settlor is a former Canadian resident, same kind of Cayman trust structure, but if the beneficiaries are all non-residents, then it's outside the NERT rules. If you wanted to have Canadian residents as beneficiaries, you'd have to wait 5 years because there's a 60-month window for people coming into Canada and for people leaving Canada. And if you're outside of the 60 months, you don't have a NERT. And finally, if the settlor were to, even being a resident of Canada, die leaving a testamentary trust in place with the same kind of Cayman structure, so long as the beneficiaries are non-resident, then it's not a NERT. With that's our signal. The last slide is perfect. Just one final comment on this. The rules say that if a person leaves Canada, they have to wait 60 months to set up a trust that's not a NERT. But if they die, they only have to wait 18 months. So if somebody is out 19 months, dies, has a will, sets up under that will a trust for Canadian resident beneficiaries, it won't be a NERT. That's an exception. So that's a lot of material that you've gotten today. I want to thank you for your attention. Please do fill out the evaluation forms, and the panel will remain here if anybody has any questions, and we look forward to seeing you at our next Toolbox seminar. Thank you.